Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Matt Justice from Tackle Trading. Recently on a Trading Justice podcast from last week, we were talking about earnings, and the number one risk to a long-term investment is earnings, and earnings happens every single quarter. And one of the reasons why we own long-term stocks for the long haul is because we want to capture dividends, or we want to capture cash flow, or we want to capture growth. One of those three. So growth, cash flow from the covered call, and dividends. And the question came up on Netflix because Netflix was reporting earnings last week, and I own Netflix. Was basically, how are you going to handle Netflix going into earnings? Well, I owned Netflix, and I had a covered call on Netflix. So basically, what I was talking about was adding protection to the actual investment on Netflix to cover the earnings risk. And basically, we went through the discussion on how we do that. And what followed was a series of emails from some of my students who basically were like, well, Matt, how do you do this? It sounds really awesome, but how do you do it? What is the practical application of it? Well, what I'm going to do today is basically I've came into the Thinkorswim's On Demand. And what the Thinkorswim On Demand is, it's a really, really, really cool technology. Basically, you can go back in history and simulate transactions, which will allow you to backtest, practice, and you can put in a lot of practice with the on-demand without actually waiting for all these trades to actually happen throughout real time. And so what I've done is, and I can't do it on Netflix because Netflix, the date is not there yet. You can only go back to so many dates. And so what I've done is I went back to here April 11th of this year, and we're looking at a company named Fastenal. And Fastenal is basically nice little uptrend here, a little bit of a retracement. Looks really, really good here. There's nothing that we're too cautious about. The trend's been really strong, one of the strongest stocks in the entire market, to be honest with you. And over since last earnings, when it came back down into $36, it's climbed all the way up to $50, back down to 46, and now it's on the way back up. What you can't see is right here. The next earnings date is tomorrow. So what I've done is I'm basically going to simulate this transaction to show you kind of how it works. So let's say we own 500 shares of the stock. This is what your risk graph is going to look like. It's what I refer to as vertical. As it goes up, you make money, and as it goes down, you lose money. So let's say it goes up to $52. Okay, awesome. You make $2,400 from this point on. Let's say it goes down to $42. Well, you're going to lose $340. So the risk is obviously to this side of the risk graph in the downside equation. Now, most of the time, not all the time, but most of the time when I own a long-term stock, I'm also selling calls against it to form a covered call. And that's what this will now look like. Okay, so basically, you're just cash flowing on the stocks. We've sold five call options. May 16th, I'll show you the actual trade here. May 16th, $48 call options. Somebody's going to pay us about $150 per contract, 5 contracts, $750 of cash flow. So basically what we're doing here is we definitely want to own the stock, but we just want a cash flow. That's it. We just want a cash flow. Let Fastenal go wherever it wants to go. Cash flow, cash flow, cash flow. Cash flow is absolutely king. Now, in terms of that 500 stocks, okay, we're looking at right around, if you go, and we'll pull up a calculator here to show you kind of how much we're going to make here. So if we buy 500 shares of Fastenal at $47, so 500 shares, so we take 500 shares times 47.39. Our investment is going to be right around $23,000, okay? And that's in an IRA. In an individual account, a margin account, using standard margin, you can cut that cost down in half. So our initial investment is $23,695, and that is for 500 shares of the stock. Well, now, if we're going to sell call options against it, we're going to receive $750. So if we're going to receive $750 divided by our initial investment of $23,000, we're going to receive about 3.2% ROI every single month. That's why we do the covered call, just cover, 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 cover. Now, in terms of this, awesome transaction, 3% a month, give it to me every single month for the rest of my life, and I'll never worry about money again. But again, the risk is, well, what about earnings? Last time, earnings came down. Last time, earnings came down. Earnings here initially came down before it responded and had a nice little bull run throughout the month of February, March, and now into April. So the risk to owning the stock and the risk to that cash flowing 3.2% for the rest of your life every single month is earnings. And you know what? It could go up and it could go down and it could do nothing. And if there's one thing traders really don't like, if there's one thing investors really don't like, it is that of uncertainty. We can determine probabilities, we can determine breakouts, we can determine technical analysis, we can determine fundamentals and economics and all this stuff, and we can use all of those tools, behavioral analysis, fundamentals, technicals, and economics, to project future expectation. But the one thing we can't determine for certainty in any capacity is earnings. It is 100% uncertain event. And because of that, we have to make a determination whether or not we want to add the protected put option to that covered call. See, if you just buy a stock, it's what we call long stock. If you buy a stock and you sell a call option against the stock, it's called a covered call. If you buy a stock, sell the call option, and then buy a put option to protect the downside, that is what we call a collar trade. Some people will refer to it as a minimal risk collar trade, but I just call it a collar trade. Okay, everything we do in terms of covered calls, it's minimizing risk, stop loss, minimizing risk, diversification, minimizing risk. So this is a collar trade that you do in to protect against the earnings gap. So what we do now, coming back to the Analyze tab, is I'm going to take the cash flow received on the call option, which is $750, and I'm going to go buy an out-of-the-money put option. The out-of-the-money put option that I like to buy is right around the 25 delta. Okay, so I still have cash flow if I'm wrong. Okay, I still make money if I'm wrong, but at the same time, I want to protect that downside risk. So now, if we come back to the risk profile, here's our risk profile on the covered call. You have capture gains to the upside for the month, not for eternity, just for the month, because that's what we get for the 3.2% ROI. And we've limited our risk to the downside with the covered call. Once again, if we take this away, we have $2,300 of potential risk going down to 42. We bring them back on. We've capped that risk down to 1,700. Now, in terms of this, now if I add the put option, this is what the risk graph looks like. It really does a great job of minimizing the damage to the downside. And once again, let's go back up to $47 because that's current price. So it really does a great job of minimizing any potential damage if the stock does in fact go down to the on earnings. And again, this is something we simply don't know. So let's see how this plays out in real time. Okay, so let's go to the monitor tab, and what I've done here is I've added the trades on last Monday, on April 11th, added the trades in the on demand to simulate this. Now, let's close these trades real quick. So I'm gonna close the call side and the put side very quickly. Now what we have here is we just have Fastenal. I've just closed out of the other trades to simulate to show you kind of the earnings report. So let's go to the chart here, and we're going to fast forward one day. We're going to go into April 12th here, and we're going to click on go, and here's simulate. Now as you can see, look at the price movement here. Boom, boom, boom. Just really gets hammered there at the very beginning of the day. Opened up all the way down here around 44.98. If we change the time frame here, let's go right at the open and show you what happens right at the open. So let's go there. Okay, so now here we have Fastenal. Boom, just gets absolutely I don't want to say butchered, but it's down quite a bit. Well, let's come to our long-term investment. Oh my goodness, we're down $1,000 on an $11,000 investment using margin, obviously. We're down about 10%. The stock's down about 5%. We're down about 10% in one day on earnings when we have zero probability being right. It's a 50-50 coin flip type situation. So now let's go back in time. Let's go back to the 11th and let's buffer that. Okay, so we're back before earnings again. Obviously, earnings report hasn't happened here. Let's go to the trade tab. Now what I'm going to do is I'm going to add those call options. I'm going to add those call options, and we're not going to buy there. We're going to sell. So we're going to add these call options in terms of selling the call options on the actual covered call. Now let's simulate that transaction on the covered call coming once again into earnings. So as you can see, I own Fastenal here, 500 shares. I've sold 5 call options against the stock in the form of a covered call. Now let's simulate to the next day. So let's go to the 12th here. Now we simulate to the 12th. We're still down 1,000 on the stock, but look at the call options. The call options, because you have sold them, they are negative delta for you, which means as the stock is going down, you've offset your loss, which means you have offset your loss by 50% simply by selling call options against the stock. As you can see, we've lowered our risk against the stock. Now, we still have $500 risk, so let's go back to the 11th here. We're going to go back to the 11th, and let's now add those put options. So once again, I've sold the 45 delta, 48 strike price. I'm now going to go buy 5 contracts on the 25 delta. So now let's go back to the monitor tab and look at this. We own the stock. We've sold the call options in the covered call. We've added the put options, which is called the protected put. Now this entire transaction right here, it looks 3 transactions. Buying the stock, selling the call, adding the put option. That is called the collar trade. We're lowering the risk. Everything about this is just lowering the risk to take the uncertainty out of earnings. And so let's now simulate to the next day. And let's see what this has done. All of a sudden, we've lowered our risk. Okay, so basically, we've cut out 70% of the potential risk just by adding the collar trade. And that is what we were talking about on the podcast from last week on Netflix. It's one of the biggest risks to a long-term investor. And this was an example on a stock that went down 4 or 5%. Netflix went down from $107 down to $92 over a 2-day stretch. That is risk you have to protect. Now, not every stock you have to do this on. Some stocks are very slow moving stocks that don't move a lot. But if you have a stock that is volatile, if you have a growth stock, if you have stocks that are that have a history of moving tremendously on earnings, you need to look at the collar trade coming in earnings. And even if you pull off those call options, you need to look at that to add the insurance just in case something dramatically bad happens. And I wouldn't say this is dramatic on Fastenal, not in any capacity, but at the same time, I would much more add the insurance, the protection, than taking this potential risk to the downside. Covered call that, add the put options, create the collar trade. This is Matt Justice for Tackle Trading, bringing you a video on long-term investments, covered calls, and collar trades. If you like the video, guys, go make sure you hit the like button over there on YouTube. Make a comment over there at Tackle Trading. Let's continue the discussion in the comment section after the video. Matt Justice, Tackle Trading, get in the game.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.